Welcome to Your Weekend View, where we bring you the latest insights and trends in real estate investing. I'm your host, Daniel Brereton. President Trump announced this week that he's giving, quote, serious consideration, end quote, to bringing Fannie Mae and Freddie Mac public, with plans to retain government guarantees and oversight even after privatization. The mortgage giants, which have been under federal conservatorship since the global financial crisis in 2008, now generate significant cash flow and appear financially stable and ready enough for transition. The announcement, of course, sent those shares soaring, with Fannie up 51% and Freddie up 42%, their highest levels in 16 years. But beyond the trading frenzy lies a more fundamental question. What does this privatization, this taking these companies public, what does it mean for commercial real estate investors? Fannie and Freddie currently support about 70% of the U.S. mortgage market, and they provide liquidity that keeps money flowing to home buyers and, crucially, to commercial real estate borrowers. Their government backing has allowed them to offer consistent, predictable financing terms. It's been a stabilizing force that private markets alone just can't support. The implications for commercial real estate run deeper than many realize. These entities provide necessary liquidity to the multifamily lending market, in particular by purchasing loans and packaging them into mortgage-backed securities. Without that steady appetite for loans, lenders become more selective, terms tighten, and borrowing costs tend to rise. Experts predict that mortgage rates could jump by a half to a full percentage point immediately following privatization, even with government guarantees intact. For commercial real estate, that translates to higher acquisition costs, compressed returns, and potentially lower property valuations as cap rates adjust to reflect additional financing expenses. But here's the nuance. Trump has clarified that, quote, the U.S. government will keep its implicit guarantees and maintain oversight. This isn't full privatization in the traditional sense. It's more like changing the ownership structure while preserving the underlying financial framework that markets depend on. For CRE investors, the key is recognizing that structural changes to mortgage finance create both risks and opportunities. Higher borrowing costs may pressure levered equity returns, but they also create attractive entry points for debt investors and can drive more capital towards hard assets as traditional fixed income yields become less compelling. In times like these, the advantages of commercial real estate become clearer. Tangible assets with income streams that don't depend on government structure changes, diversification benefits, and the ability to adapt to new financing realities through creative deal structures. All of these being very attractive and, I think, provided by commercial real estate in the private markets. Thanks for tuning in. Stay patient, stay diversified, and we'll see you next weekend.